Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you have joined us for our Oil and Gas Conference. Our next live presentation is from Saturn Oil and Gas. Please note, you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings by clicking Book Meeting in the top toolbar. At this point, I'm very pleased to welcome Justin Kaufman, Chief Development Officer, and Cindy Gray, Vice President, Investor Relations of Saturn Oil and Gas, which trades on the OTCQX Best Market under the symbol OILSF and on the TSX under the symbol SOIL. Welcome, Justin and Cindy.
Thank you, Greg. Good morning or good afternoon, everyone, depending on where you are. And thank you for taking the time to join Saturn Oil and Gas to hear more about our unique strategy and blueprint for generating value. As Greg mentioned, my name is Cindy Gray, and I'm the company's Vice President of Investor Relations. I'm joined today by Saturn's Chief Development Officer, Justin Kaufman, who will provide a deeper dive into our assets and our development focus, along with our capital program later on in the presentation. For those of you who are unfamiliar with Saturn, we're a Canadian energy company and publicly traded, as Greg mentioned. For the second year in a row in 2024, we were also recognized by one of our country's largest news publications, the Globe and Mail, as Canada's fastest growing oil and gas company, demonstrating the magnitude of our growth over the recent years. I just want to remind everyone that all dollar values we mention today are in Canadian unless otherwise stated. I won't spend any time on this slide, but encourage you to read it at your leisure. Now we'll get into the company overview. Operating in Western Canada, we're focused on increasing per share value through the development of primarily light oil and liquids. Our low decline asset base features almost 20 years of development inventory across the provinces of Saskatchewan, which is above North Dakota, and Alberta to the north of Montana. One of the things that sets us apart is our Saturn blueprint. Deploying this blueprint, we have grown from a few hundred barrels per day to more than 40,000 BOE per day over the past 4.5 years, largely through acquisitions that were financed with a combination of equity and debt. After each acquisition, we focus on following our proven roadmap to enhance those assets and reduce net debt with the higher free cash flow that's generated. Today, we are both repaying debt and buying back shares, a combination designed to support per share metrics and enhance our multiple. As you can see here, Saturn's blueprint provides a formula for unlocking value from mid-life cycle assets that were previously owned by others. First, we acquire, targeting accretive oil-weighted assets that are mid-life cycle, not exploratory, but development, and where the infrastructure is already built out. This allows us to direct more of our capital to high-value activities like drilling and completions. Then we optimize, we streamline costs, capture synergies, optimize production, and expand our margins. Debt reduction comes next. With higher free cash flow that can be generated from these assets, we focus on improving leverage metrics. We target to bring our net debt to adjusted EBITDA ratio to 1x or less in the 12 to 18 months following an acquisition. And finally, we repeat, as this pattern provides a proven framework that we have successfully executed since 2021. Our acquisitions to date have established Saturn in 3 core areas, with production of approximately 40,000 BOE per day, weighted to 85% to oil and liquids. So what we're showing here is a bit of that proven roadmap to walk you through the progression of our portfolio. The yellow box in the upper right shows our original footprint, focused on light oil-weighted Viking assets. In 2021, we added Mississippian assets in southeast Saskatchewan, which we often refer to as our Oxbow acquisition, which you can see in the bottom right corner. We bolstered our original 2020 footprint with the Viking acquisition in 2022, shown here in the upper right box. In 2023, we acquired a private company called Ridgeback Resources and integrated new Alberta assets in the Cardium and the Montney oil window, as you can see on the left side, along with the Bakken-Midale play in southeast Saskatchewan in the lower right. In June of last year, we closed the South Saskatchewan acquisition, bolstering our west central assets with the lower Shaunavon-Manville plays at Battram, and added to our southeast Saskatchewan assets with the Ungar-Torquay plays at Flat Lake. Today, approximately 50% of our production comes from southeast Saskatchewan, about 20% from west central Saskatchewan, and about 30% from central Alberta. Saturn has healthy diversity in our geography across the two provinces, along with diversity in the play type, which helps to mitigate risk by enabling Saturn to allocate capital or shift capital very quickly to those areas offering the highest rates of return in any given market conditions. On our corporate profile slide here, you can see how our production has grown, with new records set in 2024, achieving Q4 volumes of over 41,000 BOE per day and exiting the year at just under 42,000 BOE per day. This strong 2024 production reflects our $246 million capital program, where we drilled 97 wells, with production contributing to adjusted EBITDA of $483 million. Today, our market cap is just shy of $400 million, and our enterprise value is over $1.2 billion. Our net debt is comprised of US-denominated publicly traded senior notes. These senior notes are termed out until 2029, meaning Saturn doesn't have any near-term repayment risk. However, with their 9 5/8 coupon, we also have a 10% annual amort payment, which guarantees systematic debt reduction. I'll speak more to this later in the presentation. In addition to growing production, the chart on the left shows the growth in our adjusted funds flow, akin to cash flow, which was $129 million in Q4 and $380 million for the year. And that equates to $2.10 per share, higher than our current trading value. After deducting our capital program, Saturn generated free funds flow of $134 million in 2024, which was allocated to a combination of net debt reduction, tuck-in acquisitions, and share buybacks. Since the launch of our share buybacks in August of 2024, we've repurchased 6.7 million shares, returning approximately $15 million to shareholders, and we continue to be active each day, buying back the maximum allowable shares. It's also worth noting that insiders at Saturn have been back in the market recently buying and have picked up another 170,000 shares over the past few days. This is over and above purchases insiders made through late Q4 and early 2025, totaling nearly 500,000 shares. All of this provides clear demonstration of Saturn's belief that the best value and highest quality barrels on the market are our own. In fueling growth to our current size, Saturn has used a combination of debt and equity to fund our acquisitions. While reducing net debt and improving leverage metrics remains a priority, we are well positioned to navigate through market volatility and meet all of our debt obligations. To insulate ourselves from volatility and provide downside protection, we have hedges in place on oil price, differential, and natural gas. For oil prices, our target is to have between 50 to 60% of our oil production, net of royalties, hedged on a rolling forward 12-month basis, and to maintain 30 to 40% hedged up to 18 months out. We've also prudently layered on foreign exchange hedges at 1.34 USD to Canadian, and that compares very favorably to the current FX rate, which is about 1.43. We've thereby locked in the principal and interest payments on our senior notes through mid-2027. As a Canadian energy company, the recent weakness in our dollar helps Saturn because we realize higher revenue given oil is priced in US dollars. However, when we convert our US debt to Canadian for financial reporting, a weaker dollar results in a higher net debt number, even though the US dollar balance on our bonds decreased from $650 million at June 30th to $617 million at year end. Yet because of the impact of converting to Canadian, it appears our net debt went up over that same period. A strengthening of the Canadian dollar would have the opposite effect, and it is useful to remember that the underlying balance on our senior notes is consistently being repaid each quarter, with another repayment coming up at the end of this month, which serves to further enhance our financial flexibility and our long-term sustainability. I'll now hand it over to Justin to talk through our operations.
Thank you, Cindy. I'm Justin Kaufman, the Chief Development Officer at the company. So a little bit on some of the Q4 highlights. To start off, our operating and transport costs. That's been one of our number one internal focuses, reducing the OPEX. And we've been able to make material savings year over year, as you see from the chart on the left. We've been able to do this in a variety of ways. Number one, technology. Using remote monitoring and physical cameras and sensors, we've actually been able to reduce the amount of labor operators to site on a daily basis. This has also helped us reduce our spill frequency as we have eyes on our wells 24 hours a day. and it's also reduced our downtime. Economies of scale. Cindy did talk about the acquisitions we've done year over year. With this scale, we've actually been able to reduce some of the higher cost items in our OPEX program, specific to our chemical costs and other operator-related costs. And also operational synergies with those acquisitions and acquiring offsetting fields, specifically in Southeast Saskatchewan, where almost all the production is tied in and sent to facilities to be separated. Well, with these acquisitions, we're actually able to tie in these production to centralized facilities, which results in significant savings. Also, with regards to royalties, most of our production is produced in one of the most favorable royalty regimes in North America, that being Saskatchewan. Every horizontal well drilled in the province has a royalty holiday on the first 37,000 barrels for the shallow tier and 100,000 for the deep tier. Saskatchewan also came out with a new royalty holiday about a year ago for open hole multi-leg wells, up to 100,000 barrel royalty holiday on, which I'll touch on later. And there's just a royalty incentive announced over this last month on low producing or inactive wells, which Saturn will complete before the end of the year. The province is looking to increase production, and royalty incentives is one way that they're doing that, which is unlike a lot of other regimes across North America. What this does is lead to one of the strongest operating netbacks amongst our peers at about $40.41 through Q4 of 2024. And now touching on reserves, a lot of records in reserves this year. Over 200 million barrels of TPP reserves and $2 billion worth of MPV value, which what this equates to on a PDP metric is a net asset value per share of $5.56. You'll see we're trading close to $2. Historically, a lot of oil and gas companies traded closer to that PDP NAV metric, which obviously we would like to creep up to. And that's only on our currently developed producing locations. If you look on the 2P side, all of our unbooked locations, up to $14 of value there. So definitely a lot of potential upside to where we're sitting today. A few highlights from those reserves: expanding the inventory of our open hole multi-leg locations. This is new to us as of 2023. We increased those reserves by 50% by year end 24. Also expanding our drilling inventory. We have about 1,100 locations booked. All these numbers are just reflected on book locations, NI 51-101 guidelines in Canada. You can only book 5 to 8 years out of development, so this doesn't include all of our unbooked locations, which we have additional about 1,200 locations. We also have our first ever booked water flood reserves in our Viewfield Creelman area. That's an area that we're going to be implementing more capital as we look to reduce declines and increase the sustainability of the company. Now looking at essentially where we're staying for declines as a producer, if you look at us compared to our peers, we have about a 21% decline, so ahead of most of our peers. And if you look at as far as our oil weightings, we'd be close to number one on an oil weighted peer average. Not our numbers, those are Peter's numbers, so it's nice to have an independent look at that. Obviously, the lower decline you have, the lower amount of inventory you have to drill on a yearly basis to replace that base inventory. As our capital plan sits right now, we'll drill about 120 wells a year, which means we have about 18 years of development inventory to maintain that 39,000 barrels a day. Where are we going to be deploying that capital? Well, most of it is going to be spent in Southeast Saskatchewan. Over 60% of our capital directed there. Southeast Saskatchewan has essentially all of our tier 1 locations. When I talk about tier 1 locations corporately, is anything that has over 100% rate of return at a $75 price tag. So we'll be drilling 3 types of wells in Southeast Saskatchewan, one being the open hole multi-legs, another being the conventional open holes, the Mississippian spearfish, and the third being the fracked Bakken and Torquays. We have been expanding on our open hole multi-leg drilling since our first ever drill in Q4 of 23. We drilled 3 more Bakken open hole multi-leg wells in 2024, the first of which up to 2 miles in length. This well was the second highest producing well in Saskatchewan in June and July, so we had great success there. Because of that success, we are going to be dedicating a full-time rig drilling those wells in 2025. We also drilled the first ever spearfish open hole multi-leg well, which was great. It actually came on about twice our initial risk type curve expectations. This is the first of its kind. We do believe we have at least 30 locations offsetting this. Between the Bakken and the open hole spearfish, we believe that we have found about $250 million of NPV10 value, and that was created organically without acquisition. Again, the second type of well we'll be drilling is the conventional Mississippian and spearfish. The conventional Mississippian generally is our Frobisher wells. If you look at the history of the Frobisher in North America, it's essentially ranked one of the top performers on a rate of return over the last 20 years. Still having high success with the company. Why that rate of return is so high, these are conventional carbonate wells, high porosity, high permeability. So the drill costs are really low. You don't have to frack these wells. Half-mile Mississippian well costs about $1.1 million. So really low capital costs, really high capital efficiencies. What we're also dedicating some capital to for the first time is some of the water flood, like I mentioned earlier, our first ever booking in the Creelman area. Inside our plate, one of the offsetting producers has actually been flooding the Bakken for years. The previous seller, before we bought the Ridgeback package, they were focused on primary development and not secondary. But we are going to be allocating capital to that, as I mentioned earlier, to lower our declines and increase the sustainability of the company. Now, looking at West Central Saskatchewan, this is actually where the company got started in 2017. Some of that early success actually is what led us to getting capital to further acquire the large offsetting packages, as Cindy talked about earlier. We'll be drilling about 26 net wells. Most of these wells will be in the Viking, actually in the Plato field. We had tremendous success there. Actually, one of them was recognized, one of our Plato wells was recognized as one of the top performing wells in the Viking last year. And because of that, we've actually opened up a homogeneous stratigraphic trend in our east and west Plato field, which we'll be dedicating more capital to. We also drilled some lower Shaunavon wells for the first time. We drilled 4 wells down there. That was part of the latest Crescent Point acquisition. We see a potential resource play of 150 wells. Really strong results on the first 4. We're drilling another 5 this year. And depending on that, we'll look to progress the capital spend in that area from there. The other 20% of our capital program will be going towards Alberta. We've had seen essentially the biggest year-over-year improvement in this area. Last year, we started drilling this area for the first time, acquired from the Ridgeback acquisition, essentially hitting type curve. This year, we were about 30% ahead of type curve. Really great success. Actually, our first ever wells in the Brazeau area was the first, second, third, and fourth highest producing well ever as a company. We drilled some 2-mile Cardium wells there. We also drilled actually the longest ever Cardium well in Canada this year, our 4 of 2 well in Lock End. It was 7,570 meters long. This was out of a sample set of 6,000 wells, so great achievement for the engineering technique. We used a combination of an RSS tool instead of a static tool and a hybrid completion design with ball drop and coil to complete this. This well's coming on over twice type curve right now. Extending the reach of this, essentially revitalizing the Cardium, and it's starting to actually compete with capital to some of our Saturn Tier 1 locations. So really exciting play for us moving ahead. And we actually excelled in our Montney play as well. We drilled a 4-well pad, came on about 35% over type curve. We actually just picked up some more land about a month ago in a land sale to further push that play to the south. So it's another area we're extremely excited about. Now touching on our guidance. So we put our guidance out in December of last year, essentially using a capital budget of about $310 million to keep that production level flat at about 39,000 barrels. Another important note is where we're spending that capital. If you look at the bottom right-hand of the chart, you'll see most of our capital is deployed in Q3 and Q4. This is because in Canada, we generally don't drill a lot through Q2. With the winter thaw, we don't move the rigs across a lot of the lease roads with the RM. So a lot of our free funds flow will come through Q1 and Q2, and you'll see that in our quarterly financials. Quickly touching on our operating guidance, some of the highlights. I did mention the open hole multi-leg Bakken and Spearfish wells. We're also looking to increase capital efficiencies, not only in the Cardium like I talked about, but in the Bakken and Torquay. We're drilling those wells longer and longer. As I mentioned, the 2-mile well Bakken earlier. Focusing on high capital return oil-weighted assets. That is because of where the commodity prices sit with oil and gas. On the Alberta side, we're focusing on more of our oil-weighted Cardium assets. We do have some gas-weighted Spirit River potential production if we do see higher gas prices, but for now we're focused on the oil weighting, and we're looking to, again, as I mentioned on the reserve, expand our water flood in Saskatchewan. And now on capital return for the year, what it's looking at for guidance is about $550 million of adjusted EBITDA. So great numbers, record numbers for the company. Looking at free funds flow around that $125 to $165 million, which is 65 cents to 85 cents per basic share price value. So great returns there. Essentially, we're looking to 3 phases here: shareholder returns, net debt reduction, and growing production per share with small tuck-in acquisitions. We did a few last year that didn't make headlines, but helped grow production in our areas. One in the Brazeau area, just offsetting our highest performing wells ever. And one's in Southeast Saskatchewan, Carnduff, acquiring some Frobisher locations, which is our most capital efficient wells. So we're also looking at, of course, I said net debt reduction, but again, those small tuck-ins to help that production per share growth. And now looking at our 3-year outlook, the number one focus of the company, obviously corporately on the finance side, is that debt reduction. And you can see based on that chart on the right, as we see that lower debt level, we're seeing higher free funds flow with that lower interest rate. So definitely focus on responsible development. I said that 3-year plan, maintain that flat production. We are not in growth mode right now, but that flat production at a $70 price tag, we're seeing solid returns, which, as I mentioned, will increase to raised free funds flow year over year. Over the next 3 years, we're looking at $950 to $1 billion in total CapEx, which equates to, as I mentioned, about 120, 130 wells per year. The free funds flow over the next 3 years, $450 to $475 million. So really strong, solid numbers here, as you can see. And now just looking at us is where we compare to our peers based off of independent analyst coverages. Our unhedged debt-adjusted free cash flow yield, number one amongst our peers. But we are trading essentially at some of the lower enterprise value to debt-adjusted cash flow multiples. I did mention our reserve NAV earlier. There's a lot of potential upside, not only to our PDP, but on our undeveloped that we are trying to realize. And we think that the solid pillar 3-year plan that I mentioned earlier will help us eventually realize that multiple. And with that, I will pause for any questions. Oh, sorry, one last slide. Yeah, it's just some quickly investment highlights. Light oil weighted asset, about 85% of our production base, which has those high netbacks, high returns, high cash flow, low decline rates, 21% as mentioned. Strong operational performance on the capital side, seeding type curves. Capital return strategy, as we mentioned. And then the prudent risk management, essentially we've been acquiring and then reducing our leverage essentially over time. And then the operating cost reductions, reducing our operating costs to some of the best in the industry highest netbacks, and working with one of the most attractive royalty regimes in Saskatchewan as a company right now.
Awesome. Thank you, Justin. We do have a few questions. So I'll start with kind of the obvious one. As a historic acquirer, what are Saturn's plans now for acquisitions going forward? How are we thinking about that?
Currently, we're just looking at smaller tuck-ins to our core areas. If you've been looking at what we've been able to year over year within our core assets, we've seen improved results. I mentioned on the Alberta side, essentially last year we hit type curve. This year we're 30% above. We think we can even improve upon that. So we have the most experience in our core areas. We like the netback and the oil weighting, so we'll be focusing on potentially small tuck-in ones inside those core areas.
And how about tariffs? How does Saturn see the impact of the potential tariffs on our business?
So the tariffs is what we're seeing were being realized through differentials. In December, we guided to a 350 MSW differential, also a 490 LSB and a $13 WCS. The WCS actually has come in with these tariffs. The U.S. is worried about getting that heavy oil down to the coast. So that has actually been moving in our favor. That being said, we are realizing about a $67 tariff through Q1 on our lighter barrels. How we've been able to protect ourselves against that is 50% of our barrels, as far as the differentials, are hedged. So we are protected from that potential tariff change. So we won't be materially affected there. Outside of the oil tariffs, we're also looking at steel and some other costs that go into our capital. And we've already located mills inside of Ontario, and a lot of our heavier steel comes from China, so we're not really seeing a lot there. And for this year, we already have a lot of our frac sand in province, so no really changes in the short term as far as how the tariffs will affect us.
Excellent. And what about bringing down our per barrel costs even more? Are there any other initiatives or things that we can do to reduce that OPEX, royalties, transport, other?
Yeah, we're always looking at efficiencies. We're always doing our RFP processes based off of our size. As I mentioned earlier, reducing our chemical costs. Also, we're continuing looking at our labor costs. We're currently operating by exception. I mentioned the remote monitoring. We're looking to bring that across all fields, which we currently do not have at the moment, but we're moving in that direction. So there is potential there. There's also additional batteries that we've identified to amalgamate that we should see some savings as well. So I would say the savings probably won't drop as materially as you've seen in the previous years, but there is still some reductions there.
Excellent. And we were asked about our ARO spend, which is estimated about $14 million for 2025. Can you give us a sense of what are some of the activities we're doing? What are we doing to address ARO?
Yeah, so to start, ESG is a big thing inside the company. We want to make sure that we're responsible steward to the environment as well as a company. Last year, we drilled just under 100 wells. Well, we actually downhole abandoned over 100. So we're abandoning more wells than we're drilling, and we're going to keep with that moving ahead. We'll downhole abandon 100 to 150 wells this year. Essentially, that reduces our inactive liability by about 6 to 7%. And that's essentially what our 5-year plan outlook is at the moment. So we'll continue with about that $13, $14 million. We're actually realizing more surface reclamation savings as well. As previously, we're focused on downhole. Now we're moving towards the surface side as well, which will reduce our OPEX as far as the amount we spent on leasing surface land. So there'll be some fixed costs coming off of our OPEX with those activities as well.
Excellent. Well, at this point, we do need to wrap it up, but I would encourage anyone, if we didn't get your question, please reach out to us, info@saturnoil.com, give us a call or reach us through the website. And thank you, everyone, for taking the time to attend today.